Sure. Hello, good evening, everyone. Good morning, depending on where you're joining from. My name is Mukesh Bhutani. I'm the chair for IFA India branch. This program today on alternate approach to taxing the digital economy is organized by US India Strategic Partnership Forum, and the IFA India branch is supporting this program. Well, it's a pleasure and honor for me to host Mr. Rajat Bansal. Mr. Rajat Bansal is a senior IRS officer, having served in many important positions in the Department of Revenue, Ministry of Finance for the past over 25 years. He is a graduate from the Indian Institute of Technology in Kanpur and also has an MBA from the Management Faculty of University of Delhi. He's held several important positions in his entire career. More importantly, he's amongst the senior most officers in the revenue services, having been in the foreign tax and tax research division. He has to his credits several landmark developments in international tax development in India. For example, he was the single contact on behalf of the government of India on multilateral instrument related issues and participated in the finalization of MLI and explanatory note. He was also the co-chair for the internal committee on BEPS during 2014 and 2016. He played a very important role in the exchange of information in Global Forum for India, Forum for Harmful Tax Practices, and Tax Inspectors Without Border. He's been extremely involved in the peer review process by the Global Forum. He also recently issued a host of circulars which has got to do with the feedback that India received in the peer review as part of the OECD BEPS initiative. Well, the topic of discussion today is on the UN approach. Why we have chosen that topic? Last time when the US-India Strategic Partnership Forum hosted a seminar, we had Foreign Tax and Tax Research Division Joint Secretary 1, who's also the competent authority, Mr. Das, addressing us on where does India stand with regard to Pillar 1, Pillar 2 proposals by the OECD under the BEPS project. Well, this discussion is clearly not complete without looking at the alternatives that have emerged. And that alternative has emerged largely because of the efforts that Mr. Bansal has put in his capacity as a member of the UN Tax Committee. Individual country responses to the coronavirus pandemic have veered towards the unilateral approach because government need quick fix to the problems on digital taxation. But governments also realize the long-term economic response planning could provide a natural opening for multilateral discussion about specific responses to COVID. Just like Pillar 1 and Pillar 2, the debate on the UN alternative approach to tax the digital economy presents a very credible alternative. Michael Lenhard, who leads the UN Tax Initiative, labeled this proposal as high point for multilateralism. As a matter of fact, Mr. Bansal was quoted in the international edition of Forbes, highlighting that these are Bansal proposals. Where, without much ado, I'm delighted to invite Mr. Bansal to present to us what this proposal is all about, how it is going to impact the world, and more importantly, how it is going to impact the US technology giants. Over to you, Mr. Bansal. He will speak for about 25 to 30 minutes. Thereafter, we will have a Q&A session with him. Thank you very much, and thanks for accepting our invitation.
You are. Good evening, good morning, and good day to everyone who has joined the session today. And thanks to the US-India Strategic Partnership Forum, as well as the IFA India branch for hosting this webinar on a very contemporaneous topic of interest to all of us who are connected with tax and business. And we are now at a stage where discussing the various approaches or various solutions being proposed in various forums is the need of the hour. And it's a privilege for me to discuss and to describe the approach that is being proposed in the United Nations Tax Committee, where I'm a member in my expert and personal capacity. And therefore, I'll be speaking in my personal and expert capacity as a member of the United Nations Tax Committee and not as a Government of India official, which I am at present. So I'll straight away take you to this interesting topic, which is appropriately named as alternative approach to tax the digital economy. Alternative is referring to obviously the approach by United Nations Tax Committee, whereas we already have a very well-known approach by the other forum, which is also a subject matter of discussion. And as Mukesh ji referred to, that we had a session on that by my colleague. And so I'll straight away take you to my presentation, and let me 1 minute change it to, yeah. So this is, just to give you an idea about the where we stand today and what has been the journey so far. This slide is just to give a background of the work on digital economy taxation, which many of you may already be aware of. Before 2013, there was already a discussion for last so many years. I think as back as 96 at least, I can see that this topic was a subject matter of discussion, and tax professionals world over, as well as in OECD, it was debated whether there is a need to change international tax rules relating to taxation of digital, so that digital economy, which is not taxed under the international tax rules at that time or at present even, is there any need to change those rules, was the subject matter of discussion. So this slide is just summarizing that. And in 2013, the real is the point of time from where we should look at the matter as it stands today, because in 2013, when BEPS project was launched, action 1 was regarding taxing the digital economy, and that action was ultimately, although it was supposed to address the allocation of taxing rights issue also, but that was dealt with in a chapter numbered 7 of that report, where it was termed as broader tax challenges, and ultimately no solution was recommended, and 3 possible ways to address the problem of taxing digital economy were given, and they were not recommended formally by the BEPS project. And it was said that if countries wish, then they can think of adopting these measures. And those measures were significant economic presence, equalization levy, and withholding taxes. After that, when BEPS project was over in 2015, then post-BEPS inclusive framework came into being, which meant that countries which were not part of the BEPS package recommendations formulation, they were also invited to join. And as many as 130 plus countries have joined. I'm not sure about the number. As on today, 130 plus countries at least are members of inclusive framework, and the work continued on taxation of tax challenges of digital economies. So all this is history, and please do not be too it's not necessary to know everything about these reports, but there was a report in 2018, interim report, and the discussion continued. And finally, in the first concrete signal or proposal to actually allow taxation of digital economies in the market jurisdictions can be said to have been tabled formally in January 2019, when OECD and inclusive framework came up with unified approach. And after that, that approach has got is refining every time the inclusive framework is working on that. And in 2020, a two-pillar approach was proposed. So at this stage of our presentation, I will just make one addition to what I have said so far, that the issue is under discussion in the inclusive framework, and it's a matter of reaching consensus, because the decision-making process there is by consensus. So once consensus is reached there, then there will be something in terms of decision for the world as to what is the way digital economy is proposed to be addressed. Tax challenges relating to digital economies are proposed to be addressed. Now, in between, one very important development took place, which all of you will again be knowing that, am I audible? Someone's message was there that...
You're audible, sir. You're audible.
Yes. So in between, there was, this is a very important development, and because it's linked to the BEPS Action 1 report, where it was said that countries can, if they wish to, adopt measures mentioned in that Chapter 7, and a number of countries, including India, imposed digital service taxes or equalization levies, or maybe some different kind of measures were taken all over the world. And these measures are not confined to only developing countries, but also have been used by developed countries in Europe and elsewhere. And more or less, they differ in terms of the scope, as to what is being taxed. Of course, digital services and digital transactions, but they may differ in their structure, and the rate may differ slightly. So all of them, these measures were imposed, and this found this was something which has, as all of you know, has been a subject matter of concern and subject matter of debate, because strictly speaking, these taxes are not leading to elimination of double taxation due to the treaty rules coming in the way, and these taxes being outside the taxes covered by the treaty. Now, parallelly, let me now take you to what has happened in the United Nations Tax Committee. So first of all, let me tell you that United Nations Tax Committee is a committee of experts, 25 experts from 25 countries, selected by the United Nations on nominations by the respective governments, both from all over the world, and they have a 4-year term, and the committee works on various issues of importance in international taxation. So in 2017, the present committee's term started, in which I'm also a member, and this goes up to 2021. Next year, this committee's life will be coming to an end. And here, a subcommittee was formed in 2017 to address the tax challenges of digital economies. Now, because, as you know, the work was going on in the other forums, so since beginning, the issue was as to what this committee is supposed to do. And it was a logical question. And then the committee meets twice in a year, and it met for the first time in October 2017, and thereafter twice in every year. And in the beginning, quite a bit of time was spent on what the committee should do. And meanwhile, the committee, of course, kept a track of what was going on in the other forum. And some of the members, including myself, we were of the view that this committee should also start working actively on this challenge and try to find a solution independent of the work going on in the other committee, because other forums, because if we start our work after the other forum has come out with its solution, then there will be no time left for us to really come out, really work on something tangible or which will be acceptable to the world. And the mandate of the United Nations Tax Committee is to work in the interest of developing countries. So we must examine whether the solution that is being discussed is really in benefit of developing countries, in terms of implementation, in terms of administrability, in terms of share of revenue. So this discussion went on in the committee, And in 2019, it was decided that UN Tax Committee will work independently on this topic while taking into account the work being done in other forums by paying special attention to the interest of developing countries. And one important decision taken was, because then the issue was how it will work independently, because members here had different views. Members are from developing countries, from developed countries, they have different views. So I had proposed at some stage that allow members to come up with a proposal themselves instead of the committee as a whole coming up with a proposal, and let that proposal be discussed by the committee. So in consequence to that, in May 2020, a proposal was submitted by me. And then in 20th session in June 20, as recent as June 20, that proposal was discussed, and the committee approved that that those in favor of this proposal or having a solution for this problem may constitute a group, and they may come up with a draft proposal as to that will be put before the committee. So that's how a drafting group was formed. And myself and Carlos Proto from Argentina, we along with our colleagues from developing countries, 13 of us at that stage, and later one more joined, so total 14 of us came up with we drafted a proposal, which is Article 12B, as it is, as you might be knowing. And that proposal was first discussed in the subcommittee meeting of the United Nations Tax Committee in August 2020. And thereafter, it was the comments were received in August 2020 meeting, and the drafting group refined its proposal and responded to various comments received from the members, including USCIB also. And then that was published on the website of United Nations Tax Committee as a conference room paper before the 21st session of the committee in October 2020. And in October 2020 session, after a great deal of debate in which observers also participated, independent observers as well as country observers, the proposal was approved in principle for adoption in the United Nations Model Tax Convention. Now, let me also just add, for those who may not be knowing, that the United Nations Tax Committee works on upgrading or revising the United Nations Model Tax Convention for negotiations of tax treaties between, basically it's a model for negotiations between developing and developed countries. And it is constantly updated by the United Nations Tax Committee. And the proposal is to add an Article 12B in that Model Tax Convention, which will in turn be used by countries all over the world for negotiating their own bilateral tax treaties. So that is the idea. And the proposal at this stage stands at an in-principle approval for insertion in the model, but there will be meetings of subcommittee and meetings amongst the members to look at the commentary and to include views of those who are not in agreement with this, because as is the convention in United Nations Model Tax Convention, minority views are also reflected in the model, and accordingly the commentary and the article will be put for approval in the last session of this committee in April 2021. Now, let me, because, it's very necessary to understand what this whole thing is about. And I tried to put that in by way of this slide, which is a very basic slide. You see what the problem or these elements of this problem are with, firstly, whether to tax. Till, I would say, till 2019, the debate was whether to tax. And there were different views, and never was any view clearly expressed that there should be a taxation by changing the international tax rules. And it was for the first time that a kind of agreement seemed to have emerged in shape of unified approach in January 2019, where the taxation should occur was accepted. How it then after that, according to me, that issue has kind of got accepted by most, although some countries and some may still be questioning whether there is actually any need for changing the international tax rules. Now, next question is what to tax. This is another dimension of this problem, which is very important, whether one should tax digital services, whether one should tax goods supplied digitally, whether some of them should be taxed or all of them should be taxed. And related issue of ring fencing is always raised that if something is taxed, it should not lead to a different set of rules for something else. So next issue is how to tax. Now, how to tax is where the United Nations Tax Committee approach and the other approach are differing. That approach is kind of a top-down approach that the determination will be in a centralized manner, whereas the United Nations Tax Committee approach is the traditional approach that the countries will tax in their domestic law, and thereafter the treaty will come into play to permit that taxation rather than obstructing that taxation as has been happening till now. Now, next is very important, how much to tax, because ultimately how much to tax is going to be equally important, whether it should be only a portion of non-routine profit or something else, then how it should be measured, because measurement here is not simple due to accounts being not market jurisdiction specific, and any approach that is used will have to use some sort of approximation. So measurement should be done in what manner? What numbers should be applied for allocating share of non-routine profits or routine profits or trade intangible related profit or marketing intangible related profit? So that's the last dimension in this slide. Now, I turn to why an alternate approach was thought to be needed. I did refer to it when I was describing the process in United Nations Tax Committee, but I have tried to summarize it on two dimensions only. The first one is complexity. Now, since United Nations Tax Committee works for the interest of developing countries predominantly, and also for developed countries, but its stated policy is to work especially in the interest of developing countries. Therefore, complexity, according to me, is important for everyone, not only developing countries, maybe more so for them. And the approach should be simple. It should not be difficult to administer. Otherwise, according to me, complexity itself will lead to more disputes than anything else. If you make the approach very complex in terms of what should be taxed, how it should be taxed, and how double taxation should be eliminated, how revenue should be sourced, all these aspects of the taxation of cross-border transactions, if it is too complex, then firstly, the tax administrations may not be able to cope up with it. And secondly, chances of disputes will be more. Now, the other important aspect of due to which alternative approach is needed is what is the share of market jurisdictions ultimately through any approach that is taken. Now, if we talk about it, then ultimately, if there are many thresholds in an approach due to which quite a large number is not taxed or is outside the purview of the taxation, even though they are carrying out the same activities as anyone else who is proposed to be taxed, then the base shrinks. And various kinds of thresholds will also make it complex. Then what is the amount that is being subjected to tax? One view was that it should be only non-routine profits that are subject matter of taxation. Even if we take that to be theoretically I do not ascribe to that, but even if we accept it to be the case, then measurement is the issue. Ultimately, are we able to measure that? What is the non-routine profit exactly? Or are we going to use an approximation there also? And out of that also, if you want to bifurcate bit further, then is it a methodology to really measure that, or we are on approximations? And at the end of it, if our economic impact analysis, what is it showing? Is it showing that a I mean, it's very difficult to say what's fair or what's reasonable, but still one can have an idea and one can gauge whether the numbers you are getting are yielding something or something reasonable for the market jurisdictions, which was the whole objective of this exercise, to really go in for that approach. So on these two parameters, let me say that firstly, complexity, the tax committee approach is quite simple in that sense, although some of the comments received do point out some issues, but still I would say it's very simple in that sense. And it is, most importantly, it is following what has been done till now for the cross-border transaction taxation under the tax treaties for business profits. And though all that is being done is to create a new nexus rule, but at the same time, it is in implementation like what it was till now, what the tax administrations are used to, and they will go on doing that, maintaining their own right to determine what they want to tax. And share of revenue also, because there is no threshold prescribed in Article 12B, even though locally countries may like to exclude very small transactions from the purview of this article. But as such, in the article itself, no threshold is contemplated. So in a way, all entities which are doing cross-business transactions proposed to be covered by this article are subject matter of tax, and the taxation is on their entire profits at a reasonable value. And I mean, it appears that what the market jurisdictions will get in terms of revenue from this proposal can be said to be reasonable and fair. And on these two parameters, I think the approach is helpful for developing countries. Now, this is sometimes the issue arises as to why only Article 12B is targeting to modify the treaties, and what about the domestic law and domestic guidance for countries to have measures to tax the digital transactions. Now, as we all must be aware that so far the practice has been that domestically countries impose taxation, and tax treaties provide a framework under which the taxing rights are allocated between the two treaty partners, and its tax treaty never suggests that whether to tax a transaction or not. That's not the that has not been the practice, and internationally, the choice of taxing any transaction has been left to the countries concerned. Now, why modify tax treaties? Because tax treaties have a rule at present of allowing taxation of business transactions only if there is business profits. Transaction is permitted only if there is a physical presence in the country in the other country where the foreign company or non-resident is operating, or he has personnel in that country, what is known as service permanent establishment or agency permanent establishment. So only under those restricted situations taxation is permitted, whereas digital transactions have digital businesses have models that do not really need these conventional ways of doing business. Therefore, tax treaties are the main obstacle to tax any digital business, even if it is operating in a market jurisdiction at a very significant scale. So that is why there is a need to have a tax treaty modification. And tax treaties also have a very important role to play in terms of elimination of double taxation. The mutual agreement procedure under the I mean, not the mutual agreement procedure, but the elimination of double taxation is an obligation of the treaty partner if it is in accordance with the tax convention. So that's a necessary condition. And once it is in the tax treaty, an article of this kind, then if the taxation is in accordance with that, then it is obligatory on part of the other country to eliminate the double taxation. Now, I think this is the last slide. And what is the structure of Article 12B? I have called them pillars of Article 12B. And the first one, I have bifurcated these into four broad most important features. The first is that the scope of taxation under Article 12B is automated digital services. Second is that there is a provision to allow taxation on gross basis in the country, in the market jurisdiction or country of source, as it is called, on a gross basis by imposing a withholding tax. And that rate is not provided in the draft article as of now. In the commentary, it is stated that it could be around 3% to 6%. Now, third one is option of net basis taxation, because, as you know, although gross basis taxation is very good from point of administrability and from the point of view of simplicity, but sometimes people may say that we do not earn this much, so we have losses. So in those cases, option of net basis taxation on annual basis is also provided in paragraph 3 of the article, and those who want to opt for that can do that. Lastly, the interplay with other articles, because as ADA, automated digital services, are described, there may be situations where that income may also fall under some other article of the tax treaty, for example, under the fees for technical services article, or maybe under the royalties article. So a clear rule is provided now as to which article will apply when there is a situation when it is falling under both. So I think with this, I'll stop and hand over to Vijay for taking us.
Thank you very much, sir, for defending your proposals. Now let's move on to the Q&A session. Clearly, there has been intense criticism about the UN proposal, and I know that you very passionately defended it in last month's UN Tax Committee meeting. But just for the benefit of all our listeners, I would start off with a very generic question, which is 12B a credible alternative for harmonizing the international tax system across jurisdiction, and more importantly, avoiding uncertainties which are as a result of the unilateral measures which India also have? And will it be open to garner support of the OECD members, particularly the US? And what are the key negotiation points from your perspective?
So, is it a credible alternative, and whether it will be able to address the unilateral measures, and whether OECD countries and developed countries will be ready to adopt it, are basically very, very valid issue relating to someone's mic is on probably. Now, first, let me address the issue of unilateral tax measures. So, unilateral tax measures were imposed because by most countries, because the tax treaties were in the way, and they did not permit taxation without a permanent establishment, and therefore these unilateral measures came into being. Once there is a provision in the tax treaty to eliminate double taxation and permitting such taxation, which 12B does provide an option for, then I do not see why any unilateral measures will remain and there will be, the countries will naturally change it to a tax which is under the tax covered by the tax treaties, and the so I do not see any problem in as far as unilateral measures are concerned. It appears very natural and normal to me that these will get automatically eliminated, and very smoothly the transition will occur from unilateral measures to a normal tax and a normal elimination of double taxation. So the next point is that all countries will be open to include this in the tax treaties, in the bilateral negotiations. I'm not, although this is one point being raised repeatedly, but I do not see why it would not happen. Because you see, let us look at the fees for technical services article. I can say that at least in India's tax treaty, it was there even before it was brought into the United Nations Model Tax Convention, and countries all over the world have this article in their treaties. And I do not see anything so drastic about 12B that countries will not want to adopt it once it is in the United Nations Model Tax Convention. Neither it is very it's having a very heavy burden of taxation. It has flexibility. It's simple. So I do not see why there would be a strong resistance to adopt it, but that's my view. I may be right or wrong, I'm not sure. And you also asked its long-term sustainability. I do not see any problem in that. Once this is in the model and once this is included in the treaties by and by, then at the moment it covers one segment of the businesses, that is the ADS or automated digital services. But tomorrow, if there is appetite for increasing its scope, that can always happen. And at least you can see that DSTs are mostly overlapping with what is the scope of ADS. So I see that major part of the problem will get addressed if this article is brought into the United Nations Model Tax Convention.
Sir, Mr. Bansal, in general, as a tax policy stance of the government, should apportionment methodologies to address digital taxation is a fait accompli, whether you take the UN or the OECD model? The question that arises is, should the arm's length principle be modified with nexus rules to address the challenge? Now, this is particularly important since so much time was spent on action point 8 to 10 to provide a credible basis to tax income that is arising on value creation or arising out of hard to value intangibles, all included in it. So do you think that the UN proposal would have been more acceptable had it overcome the real challenge in the OECD proposal, which is the apportionment methodology? Because most countries do not like the gross basis of taxation. They want to pay taxes only on profits. So do you think that we are kind of short-circuiting the arm's length principle, or that could have been modified with the nexus rules to address the challenge?
Firstly, let me say that the United Nations Model Tax Convention and the OECD Model Tax Convention differ in this respect in Article 7. The United Nations Model Tax Convention has a paragraph 4 where apportionment is already, I may be wrong about the number, but there is a paragraph where the United Nations Model Tax Convention already refers to using methods to apportion. And in this particular situation, more importantly, how will the arm's length principle approach be applied to tax these businesses when they don't have any accounts or presence in the market jurisdictions, I'm not able to comprehend. I mean, ultimately, considering the very characteristic of these businesses, the way out could only be an apportionment method and an approximation, and that's what both approaches are doing. So I really do not think that it's possible to really apply the arm's length approach to tax these businesses.
Thank you. Sir, one of the other questions that is getting raised is the UN consensus-based approach actually possible given the different political agendas of the developing or emerging countries, which are also the market jurisdictions, and developed countries? Considering that income reallocation to market countries will result in a surrender of tax space by the developed countries, do you think that the political agendas will actually meet to make this reality?
No, firstly, as I said, maybe I did not say, but United Nations Tax Committee does not work on the principle, on the basis of consensus. Here, the decision is by majority, simple majority. The other forum does work on the principle of consensus. And whether there can be a consensus on such an issue is anybody's guess. That really speaking, it's very difficult to have consensus on such an issue. Because of the conflicting interests of parties, there will always be difficulty in reaching consensus. And but still, because of the after weighing pros and cons of the issue, for example, at the moment there are unilateral measures, and those are proliferating. So that's why probably I think the unilateral measures have been a very a factor affecting the progress of this work. And it's in everybody's interest to come up with a solution which is agreed upon, and whether by consensus or by majority. So ultimately, I do not see that under either approach, it will be impossible to have either a decision by consensus or by majority, because the situation cannot continue unresolved or unsolved. And at some stage, everybody will really realize that this problem needs a solution and a change from where we are at this moment.
Well said, sir. Just taking forward that point on this problem needs a solution. For large multinationals, tax certainty is one of the main goals of the proposed change in the international tax system. Besides, of course, governments trying to rearrange the allocation rights to give the rights to market jurisdiction to tax. So whether it's the OECD or the UN proposal, it's leading to the long-term sustainability with keeping in mind the certainty for taxpayers. One of the areas where people do not feel as confident of the UN proposal is because OECD is suggesting a multilateral approach, whereas UN is suggesting a bilateral approach, which means that it will depend on the countries that choose to adopt the UN model that you are drafting. Is India confident that it would be able to convince its treaty partners on this bilateral approach, assuming that the UN introduces Article 12B?
This is kind of, we discussed this, I think, partly it was the question before the last one. See, I really think that this, let us keep aside the other forum approach for the time being. Let us say that this is the only, let us assume that this is the only solution available at some stage. In that scenario, I see hardly any very strong reason for this being not adopted. Because, for example, as far as sacrificing your share of revenue is concerned, your share of taxes is concerned, that's not something new. The countries have already been doing that has been doing that under a tax treaty when they agree on allocation of taxing rights between two negotiating countries. For example, in respect of the royalty article, or for example, in respect of fees for technical services, or any other income, be it capital gains or be it business profits or anything. So I do not see why this would be different for this particular stream of income. Only difference is that this is something new. This is something different from the current international tax rules of permitting taxation only when a permanent establishment as defined. That's a man-made creation. Permanent establishment is nothing sacrosanct. I mean, it has been there for so long, but it's not that that's something that can never be changed, or the business rules or the rules under the international tax rules can never be changed. When business models have changed, not probably, but there is a need to look at them again and maybe change it. So therefore, I do not see any much problem here. And as far as the interaction of the two proposals is concerned, that is very difficult to say as of now, because neither of the two proposals have reached their final stage, and it's not possible to say what will be the interaction of the two in that sense. But I'm sure that it will not be that that it's not going to be like this, that both the taxations will be taxation under both the proposals will be imposed simultaneously. That's not going to happen, certainly. Without going into the details or without deliberating on this in detail, that's for sure. I'm sure that that can never happen.
Thank you. Just taking forward the concerns expressed so far on Article 12B, the question is, will 12B subject the taxpayers to any excessive taxation? And maybe there is a comparison being drawn here with the OECD proposal. And when I use the word excessive taxation, I think the concern is, how will the market jurisdiction then opt for gross basis of taxation deal with the situation? Won't the exercise of choice, which you have left it to the jurisdiction between gross and net basis, result in some element of incongruity in the entire UN proposal?
I do not think so, Mukherjee. Firstly, let me deal with the aspect of excessive taxation or excess taxation. Now, as I said earlier, that the tax rate is bilaterally negotiable under paragraph 2, or the withholding tax rate is bilaterally negotiable. But at the same time, it's expected and that it would be around 3% or little higher, or that depending on the negotiations. So 3% of the gross, if you, for example, if you take a business with 20% profitability, and in that country, the tax rate is 30%. So let us say 100 is the revenue from that country, 20% is the profitability. So 20 is the profit and 3 is the tax. So 3, in this situation, it is around, I would say 15% is the effective tax rate. We cannot call 15% to be high. And if the profitability is low, let us say it is 10%, then the profit net rate comes to 30%, which is still within what most countries have. So this is about the gross taxation or gross basis taxation. I have tried to demonstrate with some numbers that this is not excessive. Now, coming to net taxation. Again, if you look at that, then effective taxation is not high. 30% of the profits applied to the local revenue, the tax it results into, if you look at that, it is, for example, let us say 100 is the revenue again from a jurisdiction, and 20% is the profit margin of the M&E, and 30% will be 6%. And so it is, and tax rate will have to be applied on 6. So 30% is the tax rate, then it comes to 1.8. and so that can also not be called very high. So under this proposal, I do not see why one can be apprehensive about it being excessive. And the interplay between gross basis taxation and net basis taxation is to facilitate those cases where there could be lower profitabilities or there could be losses. In those situations, the taxpayer can opt for the net basis taxation on an annual basis. So that concern is also addressed. And let me add one thing. You see, any proposal we contemplate for solving this problem will ultimately have some or other definitely issue remaining. And what we can do as policymakers or by taking into account the inputs is to do what is best possible at a point of time. So on those parameters, I think this proposal cannot be said to be resulting into excessive taxation.
So the follow-up question also on the approach of the taxation, gross versus net. And this is also a suggestion. It says, it just fallen into the chat box. It says, is there a possibility for Pillar 1 approach and the UN 12B approach to be amalgamated in some form of safe harbor proposal on gross basis with availability of foreign tax credit? I don't know whether this is a suggestion that you'd like to carry to the committee, and you'd like to respond to that.
I'm not able to understand this proposal fully. If it can be explained more, then only I can respond to this.
Fair point, sir. Moving ahead, in your view, would jurisdictions agree to a time-bound and reliable dispute resolution mechanism as a minimum standard under the proposed new UN solution, because there is no dispute resolution mechanism? For instance, will the jurisdictions adopt the 2011 modified UN Article 25, which gives an option between mandatory arbitration and some form of a mediation or a conciliation process in situations where the MAP outcome fails?
No, Mukeshji, that Article 25 alternative B is present in few treaties and not majority of the treaties. So firstly, let me say that I do not see anything different for Article 12B dispute resolution from what it has been so far for other kind of disputes under the tax treaty. According to me, this is another article in the it is going to be another article in the tax treaty, and the dispute resolution mechanism of Article 25, be it like alternative A of UN Model Tax Convention without arbitration clause or alternative B with arbitration clause, it will be governed accordingly. And I'll emphasize on the point that I do not see this leading to, at least Article 12B, leading to a flood of disputes or many more disputes than what we have been having in relation to attribution of profits to permanent establishment or existence of permanent establishment. So it will be maybe less, and therefore the channels available already, according to me, will work as efficiently as they were working. And I have always been believer that under MAP, without arbitration, one can solve the cases. And if the competent authorities look at the case with an open mind and in a spirit of cooperation, then definitely most of the cases can be resolved. Yes, there may be some cases remaining, but I do not know if arbitration also leads to solution of all the cases that are taken to arbitration ultimately, whether the result is accepted by everyone or still there is some issue. And that's a separate question altogether, whether arbitration should be brought into, and it's a policy choice of countries. So, to sum up, I'll say that I do not see any special reason for arbitration to be brought in because of taxation of digital transactions under Article 12B.
Thank you. Being mindful of time, I'm just going to hand it over to Shweta. But before that, two questions just in terms of future. And I picked this up today, where the UN Tax Committee's website indicates that the committee is targeting another meeting in December to discuss the digital tax project. Is that meeting going to occur? And if so, when? Will other digital tax focused meetings be added to the calendar in advance of the already planned or scheduled April 2021 meeting, hopefully in New York, which is what we were also being told? So can you share your perspectives on what message do we take from what the UN Tax Committee has put out on the website?
Okay. So, as I was referring to the 24th session discussion, there are going to be subcommittee meetings. I think there was planned to have two subcommittee meetings and maybe some workshop to further to discuss the commentary and the minority views. And in December, I believe there is a plan to have a subcommittee, but it is for the committee secretariat to announce it. I have not seen that notice which you just referred to. If it has appeared today, then maybe they might have put the dates also, but surely there is going to be meeting and one more meeting perhaps before the final committee meeting in April 2021.
Thank you. Just a follow-up question with the 13-member drafting committee that you are part of, is there any thinking while this drafting is occurring as to how Article 12B can coexist with, say, other digital tax rules that are getting developed under the OECD? And I understand completely that this is a parallel process, but there are withholding tax rules. Basically, the whole idea for business is to ensure that the rules don't result in significant overtaxation of business income and create additional complexities, not just for taxpayers, but even for tax administrators. I mean, are there any strategies to be able to address while this drafting process is currently underway?
No, Mukeshji, you see, convergence between the two proposals appears, let us look at it objectively, because, you know, the approaches are different in basic ingredient of, I mean, there it is M&E profits taken together, and differences are too many. I mean, it's on one hand, there is difference in scope of automated digital services and consumer facing businesses being taken together. Then the base on which tax is going to be levied itself is different. In this, not the base, but I should say the what should be taxed is different, because how much should be taxed is different. There it's complete, it's on non-routine profits. A portion of non-routine profits is the issue. Revenue sourcing is different in the two proposals, and elimination of double taxation is different in the two proposals. So I do not see whether it is possible to combine the two. Though, and approaches are different in the sense there is a centralized determination there, and it's conventional way of going about it here. So that is something which is not easy.
Thank you. Much as we would have liked to go on with this chat, which is very interesting, but I'm already being signaled by the organizers that we have to close. Before Shweta delivers a formal thank you, Mr. Bansal, thank you very much for this interesting conversation, and I thoroughly enjoyed it. With that, over to you, Shweta.
Thank you, Mukesh. I think, first of all, apologies. I couldn't do the introductions because of a technical glitch in the beginning. I'd like to thank Mr. Bansal today for his insights on the UN proposal. So you rightly said, a consensus is difficult to reach here, but till we reach there, it is refreshing to hear your views, as they say, on the other side of the story. I think given the ambiguities, we will reach out to you again for all your insights. Thank you a lot. Thanks a lot for your time today. And Mukesh, thank you so much for all your time. I'm grateful to your team as well and to the IFA team. Thanks a lot.
Thank you very much to all the viewers and to Shweta and Mukesh.
Thank you, sir. Thank you very much. Good night. Good day.